Commercial banks and savings banks lend money. This is part of their core business. The simplest form of a loan is the overdraft facility. Banks give private customers the possibility to overdraw their accounts up to an agreed limit. This is a simple way to obtain a loan, but by no means an inexpensive variant. Credit cards work in a similar fashion. They also permit holders to pay bills up to a certain limit per month. The actual amount is automatically debited from the account of the credit card holder days or even weeks later. In the meantime, credit card holders enjoy a credit. For companies, there are no overdraft facilities, but so-called credit lines, which are agreed on in advance and may be used as needed. This is called standby credit. In the case of normal loans, the total amount is agreed on in advance, and a contractual agreement is reached regarding the repayment period and the size of the installments, or if the entire loan is to be repaid in one amount at the agreed on maturity date. Banks attempt to assess the risk of default before granting a loan. Decisive in this context is the creditworthiness of the potential borrower and the size of the loan compared to the recurring income of the private household or corporate client borrowing. On the other hand, what will be done with the money borrowed is also important. It makes a difference to the bank if the money is to be used to cover current expenses or if it will be invested in real estate, other property, a production plant, or to buy another company. In the case of mortgages, it is possible to use the home built or the flat purchased as collateral. In contrast, in the case of a loan-financed holiday trip or the purchase of a television set, the money is not spent on anything that can be used as collateral. In some cases, the bank may then require a guarantor. Loans are not available for free. Banks demand interest on loans. The interest rate is based on three factors. First, the general interest rate levels play a role. The cheaper central banks lend money to commercial banks, or commercial banks make liquidity available to each other, the lower the interest on loans, and vice versa. In the euro area, the Euribor usually serves as the reference interest rate. Interest rates are also based on risk assessment. High credit ratings and available collateral means borrowers are charged lower interest rates, whereas borrowers with lower credit ratings have to pay higher interest rates. Thirdly, banks and borrowers have to agree when concluding the loan agreement if the interest rate is to remain the same over the entire span of the loan, or if it is to be adjusted in regular intervals to general interest rate levels.